Hello and welcome back to the channel. Today's video, if you've been following my channel, is, you probably guessed it, on precious metals, so gold with the new addition of silver. At the time of recording, it's important I say that because it could be a very, very different price a few hours from now. Gold is trading at $5,100 and silver is just over $100 at $101. And given gold has broken through the 5,000 level, and silver has moved beyond the 100 level, that has inevitably left a litany of questions for investors. Can this possibly continue? Is this just speculation? Am I already too late? In this video, I'll be aiming to answer those questions. Hint, I don't think it's too late. Assess what factors have led to this explosive upside for precious metals and why I believe we've entered an historic period for precious metals and the wider commodity bull market. Let's start off with numbers. Gold's up around 18% year to date and silver is up 43%. Over the past 12 months, gold has risen by roughly 80%, while silver has surged by close to 240%. Yes, 240%, essentially a 3 times return in a single year. From my perspective, that's a pretty explosive move for an asset that has been routinely dismissed as mundane, old-fashioned, and non-income producing. And for those watching my channel for the first time, I implore you to watch my videos when gold first hit 3,000 in March, and the second video when gold achieved 4,000, which was in October. Ostensibly, I'm telling you this so you can be enriched with the macro and historical context around gold, but partially it is to brag about me calling the upside early and having my clients well positioned for this move. No, but in all seriousness, I did expect these price levels to be reached. I just didn't think they would be reached this quickly. And that speed does deserve our attention because from my perspective, this marks a transition in the financial regime, one completely different from the dominance of US-centric paper assets that we've seen over the past few decades, to an investment world where real hard assets begin to matter again. And this is a theme I see playing out over the next 5 to 10 years. And despite the returns we've seen so far, I still think there is a bit of room, or a lot of room, for growth. And last week I actually wrote a report for my clients, which was outlining my investment thesis over the next 5 to 10 years. Is titled Where I See Asymmetric Opportunities Emerging Across Markets Over the Next 5 to 10 years. So if anybody wants to see this report, feel free to send me an email. I'll send it across. But in that report, there were 8 points as an executive summary for those who didn't have the time to read the full material. And I'll read those 8 points out. So the first point was there's a structural shift towards real world assets. There is a clear shift from paper-based assets and financialization to real world assets which are tangible, driven by record levels of global debt, currency erosion, and heightened geopolitical tension not seen since World War II. Point number 2, central banks are driving gold's repricing. The smartest money in the world, central banks are spearheading the price return of gold. Point number 3, silver remains structurally undervalued. The present day shortage of silver and historical price averages point to it being severely underpriced despite having a 150% gain last year. I expect silver to outperform gold, though it will be more volatile. Point number 4, which might be the most important point, de-dollarization and capital reallocation. De-dollarization is underway. Capital is moving away from US and flowing to emerging markets, and more importantly to hard assets like precious metals and broader commodities. Point 5, a major capital rotation is emerging. Technical analysis suggests we may have entered a major capital rotation event where capital rotates from stocks to precious metals and commodities. Where was I? Last seen during major regime shifts in 1930, 1972 and 2002, and potentially today. Point number 6, geopolitics and the demand for critical resources. Rising geopolitical friction, the breakdown of frictionless globalization, and the drive for energy and supply chain independence are forcing nations to secure critical resources. Assets such as silver, platinum, industrial metals, rare earths, uranium, and other critical minerals long underinvested are likely to benefit. Point number 7, mining equities as a leveraged opportunity. Gold and silver miners might be the most explosive opportunity within this theme. In many cases, equity valuations have yet to fully reflect higher realized metal prices, creating potential for outsized returns if margins continue to expand. And an 8, which is the final point, potential outsized returns over the next 5 years. If the right assets are selected, double-digit returns across the 5-year period are not guaranteed, but plausible. I firmly anticipate gold and silver in particular to be trading multiple levels higher than their current prices over the next 5 years. So some very, very bold statements, and hopefully I can qualify that for you with some evidence. But before I do that, let me just put the disclaimer out there that these are views of my own and are not associated with the company before I do get a nasty email from compliance. But let's start off with gold. So I've covered in previous videos how record levels of debt, geopolitical uncertainty, and gold's re-emergence as the reserve asset of choice were likely to drive returns. Over the past year, we've seen that thesis play out very, very clearly. In 2025 alone, central banks purchased over 1,000 metric tons in gold. 15 years earlier, in 2010, that number was just 79 tons. And for the first time since 1996, foreign central banks now hold more gold than US treasuries as reserve assets. The main reason why throughout these videos I focus on central banks when assessing these capital flow cycles is because in my view they are the smartest money in the system, and when central banks move in size they have the balance sheets large enough to significantly move the markets. And touching upon what I thought was the most important point in that report, the de-dollarization, the forces behind that and the flight to gold include concerns around US debt sustainability, not just the US, but other Western nations as well, economic warfare in the form of tariffs, and increasingly an unpredictable US policy. And before anybody does accuse me of political bias, I'm talking to you Trumpomaniacs, Trump did not start this trend. The freezing of Russian dollar reserves during the Ukraine conflict was a watershed moment. For me, it demonstrated very clearly that dollar assets are no longer politically neutral, and any country that may one day find itself at odds with the US, which currently seems to be every single nation, whether they become an economic adversary, a political adversary, militarily, they have to reassess the safety of holding dollar-denominated reserves. And my question for anybody viewing this is, do you see US policy becoming more orderly or more chaotic over the next few years? The answer to that question likely determines the direction of global reserve allocation, and it appears central banks have already begun acting on that answer. For decades, the US was actually viewed as the ultimate safe haven. And as that perception slowly erodes, gold increasingly fills the role of the neutral reserve asset of choice. And once a reserve shift begins, it rarely reverses, it tends to accelerate. And in my view, the horse has already bolted. I really enjoyed this quote from Rafael Gallardo, who is a chief economist at a large French asset management firm, which is investors, private and sovereign, believe their strategic reserves are no longer safe in dollar terms as they can be confiscated overnight. The dollar is losing credibility as the nominal anchor of the global monetary system because the Fed is losing credibility and US Congress is losing credibility. So that is a brilliant synopsis for what I think is driving the de-dollarization trend. And after understanding the factors behind the price growth, the next glaringly obvious question is it too late to get involved in gold? In the short term, I think a correction after such a large move upwards would be entirely normal. At the time of recording this video, it appears we're in one. Gold's down around 8%, silver's down about 17%. May I just add that they're still hugely up year to date. But as far as this correction is concerned, It's completely unknown whether that will last over the next couple of days, few weeks, or few months. But when you zoom out, I do not think it is too late at all to get allocated to these assets. When adjusted for global money supply, gold remains well below its 1980 peak, and to reach its 1980s levels M2 adjusted, gold would have to double. And despite recent accumulation, global asset allocation to gold is still incredibly low on a relative basis. Gold represents roughly 20% of central bank reserves compared to 60% for the US dollar. And historically, the gold allocation figure has been far, far higher. And I was surprised to learn China's allocation to gold is below 10%. So their central bank actually holds more US dollars than gold currently, and I expect that to completely shift on its head. So there's the central banks, which I think are underallocated, even though they're accumulated at record levels. And if we look at the investment world, so you look at funds and family offices, their average allocation to gold is typically under 3%. So we're talking billions, potentially trillions worth of assets. Imagine how the price would move if that 3% became a 5, 10, or 20% allocation. And given the volatility we're seeing in Western government bond markets and the Japanese market, I expect gold to be increasingly used as a balance sheet stabilizer. And there's one more quote from this report, I do promise, which is my summary in a couple of sentences about gold. And I said, in the current macro backdrop, I view gold as a financial Swiss Army knife. It can act as an inflation hedge, a geopolitical hedge, a monetary asset, portfolio insurance, a currency diversifier, and increasingly a growth asset. So that's gold. Now let's move on to this shiny metal called silver. And I think that the student might outshine the master. And firstly, let me provide some context to silver as an asset class. It shares very, very similar qualities to gold. Throughout history, it's worked in lockstep with gold as a monetary metal. Gold was the reserve asset, and silver functioned as the transactional currency in circulation. There is one key advantage that silver holds over gold, which is that it's industrially indispensable. It's been recently classified as a critical mineral by the United States, and its uses span solar energy, AI, data infrastructure, electronics, EVs, medical applications, and advanced manufacturing, amongst many more. Much of that demand is non-discretionary. And unlike gold, silver is consumed, and once it's used, it's often unrecoverable. Silver supply-demand imbalance is structural, and there's been years of underinvestment in exploration. Combine that with silver, with China cornering the market by dominating 60 to 70% of the refined silver supply, applying export controls on those. We're seeing severe supply deficits and persistent upward pressure on the metal. The returns haven't been too shabby either. Silver's up 60% year to date and has delivered roughly a 278% return over the past 12 months. For this part of the video, you might need to have your thinking cap on because I'm going to talk about a few numbers. A measuring stick that I use when assessing what a plausible future price point for gold is, a future price point for silver is the gold-silver ratio. So I try to determine, is it overvalued, and what would be a plausible future price? And it is the gold-silver ratio which I use, which simply measures how many ounces how many ounces of silver 1 ounce of gold can buy. So today's ratio sits at 46 to 1. Across recorded history, the long-term average has been around 10 ounces of silver to 1 ounce of gold, or 10 to 1. In more recent history, following the collapse of the gold standard, the ratio fell to as low as 18 to 1. And the inverse of that was during the COVID panic, when the ratio briefly spiked to an extreme of 111 to 1. So 1 ounce of gold at one point in time could buy you 111 ounces of silver. Now we're seeing half. And that was back in 2021, and it was that sort of undervaluation of silver which prompted me to add some allocation towards silver back in 21. Looking historically, historians estimate that during Egyptian times, just 2 ounces of silver could buy you 1 ounce of gold, so that was 2 to 1. And if it was just to return to the price ratio of 1971 of 18 to 1, that would imply a silver price of around $305 from today's levels. That's roughly 160% as a move, assuming the gold price goes nowhere. So the mining ratio for silver to gold is 7 to 1, and it's estimated that there's only 5 ounces of investable silver above ground for every 1 ounce of gold. I've covered a lot of numbers there, but let's remind ourselves today's ratio is 46 to 1, which to me, looking at historic and the current supply figures, it appears that silver is severely underpriced in gold terms. So alongside the industrial demand, which has been pushing the price northwards, very similar to gold, we're beginning to see early signs that central banks are beginning to accumulate to silver. Most notably, I've seen that in Saudi Arabia, China, and Russia, while the broader market remains underexposed and materially underallocated. So similar to the fund universe, where gold is the allocation is at 3%, the average allocation is nearer to zero for silver. And this might be the only argument in this video that's not yet supported by hard allocation data. However, history shows that price action itself is often the most powerful advertisement for an asset class. So I can imagine heads began to turn. Everyone's been talking about it in the office. I've been receiving a lot of texts about silver because the price has tripled over the last 12 months, which then means fund managers will begin to reassess its relevance, and institutions will test whether it actually belongs on balance sheets rather than just watch lists or completely ignored altogether. We saw a very similar mechanism play out with Bitcoin, albeit in reverse. What we saw was crypto adoption started from retail, so the man on the street in the know. Then funds began adopting it, and VCs. Then it was institutions, and then only later was sovereigns. Silver, in my view, appears to be following an opposite path. This rally's been led by industrial demand, geopolitical positioning, and in long term, that will trickle down to investment managers and retail. And I've got to say retail in the West, because in the East, China and India, there's an absolute silver frenzy. So the price of silver today is $101, and the Shanghai price of silver is $140. So there's been a mismatch between the prices for quite a few weeks now, may I just add. So silver, in summary, should continue to draw capital over time as it gets overlooked to being actively considered in portfolio construction going forward. And like gold, silver's nowhere near its all-time high when adjusted for the money supply. To surpass its 1980s peak, silver would need to trade north of $745. And that would be close to a 6 times move from the current levels, M2 adjusted. And I would not like to throw out specific price predictions, but I do expect silver to outperform gold over the next few years, albeit with greater volatility. We're already seeing it now, but expect 10% days either way where it can go up 10%, down 10% while it's on the way up. I mentioned a few other investment themes when I touched upon the report a little bit earlier on, and just in the interest of time, because I believe this will be a 20-minute video at least, I will probably look to cover some of those themes on my next video. If you'd like to see that, do let me know in the comments. But gold and silver are likely to be the tide that lifts all the boats across hard commodities, and I'd expect outperformance not just in the metals themselves, but across producers and related regions against the broader stock market. And just to wrap up, there's a few important disclaimers I'd like to say before I do give you my closing thoughts. Nothing in this video constitutes personal investment advice. Please speak with your financial advisor, or maybe me, and get to understand how much you'd like to get allocated, or how much you should be allocated to gold and silver. And if you haven't been, maybe ask why. The second disclaimer I wanted to put out there was Diversification is critical, always. Even though I've touched upon these investment themes, don't put all your eggs into one basket. Make sure you diversify that, ideally across different asset classes, currencies, and jurisdictions. That will remain critical for what I think will be a volatile period for all assets. The themes that I've explored will experience corrections. We're probably seeing one as I speak, and will have severe drawdowns. So any investments should be made with a medium to long-term horizon, hence the 5 to 10 investment window that I mentioned. And I'm not anti-US, nor am I anti-US equities, nor am I anti-Trump. I know that there will be a few viewers in the US, so apologies if it did come across that way. However, if I survey my client base, I would suspect the prevailing view would be that certain sectors for US markets are in overvaluation territory, and the currency may continue to weaken over the long term. That said, it would not be prudent at all to make a concentrated bet against the largest economy in the world. The US remains home to many of the strongest companies globally, and I think it's a bad idea to have no exposure to that whatsoever. With that said, here is my base case. If there's one thing to take away from this video, it's that the evidence increasingly points towards commodity outperformance relative to equities and currencies over the coming years, led by precious metals, of course. And you'd be surprised to know, in gold terms, the S&P 500, NASDAQ, and Bitcoin are already in bear markets. Many portfolios, in my opinion, whether those are in pension funds, whether those are self-managed, I believe are built on assumptions that will be proven to be outdated. A lot of portfolios that I see assume the dollar always rises, bonds are inherently safe, and the US equity market will deliver a consistent 10 to 15% per year. I could be wrong, but I do think those assumptions are outdated, and I believe we're in a different financial epoch. And in my view, gold sits at the center of a broader commodity boom. That's it from me. I hope you enjoyed the video. If you've watched it to the end, thank you very much. I know it was a bit more of a technical one. I would love to hear your feedback in the comment section, and I will see you on the next one. Thank you.